Thank you, Margaret. Ladies and gentlemen, thank you also SFF for having us here today as speakers. So Deutsche Bank is very pleased to be here in Iceland. And one thing we notice, since we are here quite often, but every time that a team from Deutsche Bank visits Iceland, there's more and more potential business here. It's moving in the right direction, for sure, over the past few years. And the steps, whilst they might seem quite slow for you, we see that you are taking steps forward. And you're still number 60, 68, as Oliver Wyman said, on the international chart of competitiveness, or in terms of where the banks are. But you're hopefully moving up. We at Deutsche believe that. That's why we're here. And we have taken along also the capital market side here today, both the debt and equity, and we can sort of prepare you for the future in terms of the next steps, because privatization and the debt capital markets are, of course, interesting products that could be part of the Icelandic financial system in the future. It's difficult to predict when. However, it could be that these products are coming back. Today, we'll address several questions from the Deutsche Bank perspective here. And the first question is, what does the current European banking environment look like? It's a quite broad question, and there are many specialists working on that. But we'll, of course, relay that to Iceland and discuss the new normal, which is quite different from the past. Then we'll focus on, as a second point, on what are the key indicators of a strong, well-functioning and competitive banks. As I said, the Icelandic banks are moving in the right direction, becoming more competitive, also on a European scale. And this is something very, very positive as we see it. And we'll say a few things about that. And then a third point is, how does the Icelandic banking sector compare to the wider European banking sector, also to the Deutsche banks? And I have to make some advertisement for Deutsche Bank here. We are, of course, one of the few international, true global players left, maybe the only European one, multi-product and in many, many areas. And we, of course, focus on some of the products that might be of interest to you, such as the equity, the debt, and potentially far into the future, the M&A markets. And then we look at the challenges and the outlook for Icelandic banks, which we believe will be increasingly positive. So there's a fairly good and positive message that the Icelandic financial system and the banks are moving in the right direction. What does the current European banking environment look like? And there we have a lot of potential points here. I will not focus on all of them because most of you are professionals here from the financial services industry. But these are some of the issues that we all face today. And I have to say, I've been in the banking industry for a few years, and particularly on the mergers and acquisitions and the capital market side. And I've never I've never faced as many regulatory issues and meetings internally and externally as I've over the past few years. So this has definitely moved to the forefront, because myself being on the market side, right in front of the clients, these were issues that were far hidden from my day-to-day work, but now it's very much part of it and everyday life. So Basel III, CRD4, the clarity and everything, that's something that I have to deal with nowadays, but in the past that was, of course, not part of my remit. So that's the new normal, that the regulatory environment has moved up, and that also means that some of the individuals that work with these type of products have moved to the forefront, and also part of the internal meetings that we have. So this is definitely an expense that has been added to the bank competitiveness as a whole. Here we have lots of statements and quotes from various financial luminaries and newspapers and analysts. I would just focus on one of them, the first one, because that's the easiest one. The Nordea chief says that bank regulation chokes small business loans. Basically, this is something that we see. This is Christian Clausen, of course, who has stated this, and he represents the European banks in various committees. Nordea, of course, one of the larger European banks. And we see that it's more and more, it's difficult to draw a line. Where does regulation stop to be effective? and where does it stop to be savior, and where does it start to be bottleneck instead. So we feel that it's soon reaching that point in terms of capital requirements and so on, because it is important that we also think about the business side and not introduce too many rules, because that, of course, stops our day-to-day work, makes it more difficult and also more expensive to represent you, and ultimately the client suffers. So that's maybe the last comment from my side, and I hand over to Stephen Westgate now, who works on the corporate finance side at Deutsche. He deals with this every day, and he will discuss that over the next few minutes. So, Stephen, the floor is yours.
Thank you, Jan. Stephen Westgate, Financial Institutions Group, Deutsche. So we've heard from the last two speakers about returns being too low, costs being too high, margins being uncompetitive, cost of funds being elevated. It's easy, I think, in focusing on each of those points to think that management may not have done the best job in the world to get into that position. But if we look back in the not too distant past and compare that to today, from an outside-in perspective, from the international debt investor community's perspective, from the international equity investor community's perspective, bank management has done exactly what they need to do with the tools available to them to address the challenges that they've faced. And what I wanted to do was go through a few observations from the international investor perspective, comparing the Icelandic banks to the European banking community, and then make a few observations around challenges and the way forward. So look, the way I thought about competitiveness was threefold. Firstly, the ability to attract capital and funding, both international and domestic. Secondly, the ability to manufacture, and this is the efficiency point, the cost-based point. And thirdly, the ability to provide lending into the real economy. So this is having a balance sheet that's sufficiently robust with sufficient capacity to be able to lend meaningfully to support the economy. There are 7 points around each of those three pillars. The first is regulation. Second, financial stability. Third, asset quality. Fourth, funding costs and access to funding. Fifth, efficiency. Sixth, which efficiency feeds into profitability. And seventh, the ability to grow lending or balance sheet capacity. So if I could just take a look at the European bank sector compared to the Icelandic banking sector, just canter through each of those reasonably quickly, but just to make the observation that Icelandic banks today are broadly in line with the European banking community. There are challenges, don't make any mistake about that, and there are challenges that need to be met and to be mitigated to maintain the relative position compared to the European banking community. But those challenges are clear, and I think management have a good grip on how to tackle those. And when we speak to international equity investors and international debt investors, the story it's a compelling story. Historically, or 3, 4, 5 years ago, the story was very much around restructuring, what's asset quality, what's valuation, what's going to happen. Today, it's much more around how the banking system is a sustainable, profitable, growing system, and it's viewed much more on a normalized basis than it has been in the past. So the first point is around the regulatory environment. The point was made earlier around the RWA intensity, 74% for the system versus much, much lower risk-weighted assets to total assets across the European banking system. This is a profitability challenge because it requires a significantly higher level of nominal capital to be carried. So in thinking about bank regulatory reform, it's absolutely critical that your regulator looks at RWA intensity and the ability of banks to sustain lending through balance sheet capacity by having a moderate regulatory floor. We've seen arguments in the press and from academics around how regulation feeds stability, therefore more regulation must be better because that equals more stability. That's just not true for the general economic growth of an economy. The second point is around capital strength, and we've seen this from the previous two speakers. There is an exercise required in capital structure normalization, and that's to come once A, there's regulatory clarity, and B, there's a path through capital controls. Third point around asset quality and coverage. The balance sheet restructuring exercise is largely complete for the majority of the Icelandic banks. The NPL books are very much in line in terms of size of balance sheet with the rest of the Europeans, 3 to 4%, and the provision coverage of those non-performing loans is, again, very much in line. So asset quality, no longer an issue. On the funding side, I'll ask my colleague Tommy Paxeus, who covers the debt capital markets, to come up.
Thank you. Thanks, Stephen. I had an entire speech written out, but I've actually changed it a little bit after we had our good colleagues from Oliver Wyman here, and I think they hit a few key points which are relevant. Number one, they looked at availability and affordability of finance, as you may recall. They also mentioned access to financing, and they mentioned an abundance of capital, meaning on maybe one simple variable, i.e. capital on balance sheet, one could say, yes, there's an abundance of capital depending on how you calculate it, and there should be room to maneuver and lend to the real economy on that basis. Well, as you all know, and so do we up here, that the problem isn't so much the abundance of capital. The problem is explaining to people what the variables are that actually leads into being able to lend to the real economy. And it isn't as easy as looking at one single number on a very complex balance sheet and deducing from that. The problem that you face obviously will be to explain to people that there is bottlenecks and it isn't just one variable, i.e. capital, that is the driver. In terms of availability and affordability, and I look at it as access and cost of financing or cost of leverage. Yes, we can probably agree that there is some headroom in terms of capital on the balance sheet, but is there really accessibility to financing? Is there really accessibility to financing at a cost which makes sense to lend? And that is, in my view, the real bottleneck. I've drawn up a very simplistic chart here. Basically, the bottom line being an iBox Bank senior line, which represents a broad index of senior unsecured from banks across Europe. And we're looking at spreads to mid-swaps here, so a credit spread effectively of call it 60, 70 basis points is where that index roughly lies. Now, where does implicitly or theoretically an Icelandic bank where can they raise funding today, and how does that feed into the competitiveness of Iceland and the banks? Well, if you ask 10 different people, you'll probably get 10 different answers in terms of where the spread and where the borrowing cost for an Icelandic bank is. I've chosen one simplistic model, which is I've taken a proxy, which is the Irish sovereign, an Irish bank. I've looked at the spread difference and applied it to the Icelandic sovereign and a theoretical Icelandic bank. In that case, we end up at, call it mid-200s, maybe slightly above that. If I were to choose another proxy, we'd probably end up at a very different number, be it slightly lower or slightly higher. On top of that, you also have a number of other issues which investors will look at, such as illiquidity, size of the banking sector, relevance of participating, the time of the month that they actually want to invest, and et cetera, et cetera. My key point here is there is a lot of scope for improvement from current levels. The only way to improve is to build the availability of funding. Now, Iceland Inc. and the banks in particular has done a good job so far of opening the accessibility. But there's a lot of room to maneuver down the cost of the financing, which is the key point here. Just to the broad index, there's over 200 basis points to go. Now, one could say, well, why don't we just sit back and wait for the world to turn a lot better, i.e. look at the bottom left hand saying credit drivers in Europe. Well, we just wait for the regulatory environment to get better, central banks to take more charge. We wait for supply-demand imbalance to improve, and hence the credit spread of Icelandic banks will improve, and we end up in a better situation. My point is, from current levels for Iceland, the drivers for Europe and drivers macro level does not drive the credit spread for Icelandic banks and the Icelandic economy. What drives that is, from now on, probably the main ones which you all know and love: capital controls, restructuring of the banking sector, size of the banking sector, etc., etc. Where does this leave us at? Unfortunately, I think a lot of these variables, as you well know, aren't some levers that the banks can pull. This is down to the central bank or other entities within the country to look at. What you can look at potentially within the scope of your remit would be potentially improving ratings subject to the sovereign ceiling. Choosing the right funding markets, i.e. choosing a market where investors through time will become loyal, view through the potential obstacles of Iceland specific, and discounting that. Building long-term relationships. Removing the uncertainties from your perspective, i.e. the very basic ones being legal risk and NPLs, but there's obviously more to go. Transparency, this is a big one. I think the Icelandic banks now are probably among the most transparent in terms of what you do show the market. There's still a lot of complexities around the balance sheets in terms of stripping out one-offs, but there is a lot of transparency. Now that has to continue to progress towards the ownership structure and going forward, the clarity of how the banks are built up. Now, what I've done then is I've just highlighted, well, roughly where are we trading today, or where is an implied spread, and how low could you potentially go? Well, in my view, looking at a number of different variables that Oliver Wyman and Stephen will look at later, the competitiveness of Iceland will be driven to a large part, in my view, by the funding cost, because it makes up such a large part of the input into the banks. And unfortunately, if that's high, there's not much you can do on the output. In my view, there's about 200 basis points plus to go. How long does that take? Well, I don't know how long a piece of string is. It all depends. And unfortunately, it's not all down to the banks. It's down to the sovereign to increase their ratings. It's down to the capital controls. Again, back to the basic macro and micro problems or issues that faces Iceland. But there is a lot of scope to go here. I'm not going to dwell on the last slide. All I've highlighted here is effectively one of your good peers in another region where they've actually gone into the market, started to finance themselves in 2013, and every time they've done it, there's actually been an improvement in the spread, i.e. they've started building the relationships, they've educated investors, and off they went. Yes, there's other potential things that's fed into this, improved macroeconomy, the sovereigns have improved, but the trend is clear, and every time we've seen it in the last 3 or 4 years, it's been the same trend. Stephen?
Thank you, Toby. So we have elevated funding costs that aren't justified by fundamentals that should improve over time. From an efficiency perspective, this just shows the Oliver Wyman point made before about how every bank in Europe has run a cost efficiency program over the last 2 to 4 years. What this shows is that many banks below the line destroy revenue at a faster rate than they cut costs through their cost-cutting program. Fewer banks above the line, which means those banks that are successful in minimizing revenue loss for cost control. So we need to be very careful about further cost mitigation and protecting the revenue side. But management in Iceland to date have done a very good job of doing that. Looking at the cost-income ratio, we saw earlier an adjusted number that was significantly higher than this is reported, and reported adjusted to strip out some net valuation adjustments. But you can see that from an equity investor perspective, looking outside in, very much in line. Management's challenge is to protect and defend those ratios and defend that perception through mitigating revenues falling out that are from legacy positions. Customer deposit yield, so this is the price banks pay for the majority of their funding, elevated on a European context, will come under pressure, and it's based on relative scale. So you can see the Icelandics are very small relative to the rest of Europe with consequential elevated deposit costs. But that's supported by a relatively high customer loan yield, which generates an attractive customer spread or net customer spread, which is the asset yield less the deposit funding costs. Now, this will come under significant pressure as well, but it currently is supported by a relatively narrow funding base, and as Tommy said, as funding diversifies over time, then the spread should be able to be protected through lower funding costs, all-in funding costs, offsetting the asset side pressure. Looking at net interest margin, these low three numbers are much different to the 4% plus asset spread, and that's driven by two things. Firstly, the elevated costs of non-deposit funding. Secondly, the very high level of liquid assets required, which therefore provides a NIM drag. But you can see that these net interest margins, again, very much in line with the rest of Europe. Return on equity on a reported basis, it's acceptable. The challenge for management is to defend and protect those returns on equity as revenues come under pressure through cost-based mitigation and funding side normalisation. And then on the ability to grow, the ability to support the economy, this chart shows on the vertical balance sheet capacity. So this is how much a bank can grow its balance sheet as a proportion of total assets, given the excess capital capacity on the balance sheet. And the Icelandics, because of their relatively strong capital position today, are European leading. That will change through capital structure normalisation, but today a very strong position to grow the balance sheet from a capital perspective, subject to the funding support that Tommy spoke of earlier. The horizontal looks at the ability of banks to support organic lending growth based on retained earnings as a percentage of RWAs. Again, the Icelandic banks, because of their current profitability that needs to be defended, but because of the current profitability, are in a good position to support lending growth organically. So that leads to the challenges and outlook for Icelandic banks. Touching on each of the 3 points that I've made already, ability to attract capital and funding. You know, the investment case is quite clear internationally now. The banks are no longer speculative restructuring plays. The international funding markets have reopened. There's much greater interest on the equity story from equity investors. It'll be important to get the balance right between stability through regulatory clarity and competitiveness whilst defining the regulatory framework and the exit strategy from capital controls. In terms of ability to manufacture and efficiency, cost bases have been well managed. Further pressure exists as revenue comes under pressure, but I think the way that management have delivered on cost-based mitigation strategies thus far bodes well for the future. And on ability to lend into the economy, currently the attractive asset margins support new lending. There's certainly balance sheet strength. The binding constraint is access to diversified pools of funding at attractive or economic cost, and that's improving over time as well. Moderate regulatory capital floors will certainly be important to maintain the balance sheet capacity that the banks currently have. And of course, the challenge remains in competing with external competitors, the larger Nordics in particular, who can cherry pick the more profitable business domestically. But as cost-based mitigation comes through, as funding costs normalise, we saw from Oliver Wyman, pricing should come down, and the banks will be in a better position to compete. I think I'll leave it there. Thank you very much.